Hello, everyone. I'm Manels. Accretion and dilution in M&A are not just academic concepts. They are the first economic filter that the market, board of directors, and buy-side investors use to determine if a deal is worth further discussion. In investment banking, private equity, and corporate strategy, this is an essential skill. If you can't quickly calculate accretion and dilution with numbers, you don't truly understand M&A. So today, we won't memorize formulas. We'll use a problem-solving approach to quickly learn it. First, let's look at the fundamentals. Company X has a net income of 600, 200 shares, a stock price of 60, an EPS of 3, corresponding to a 20 times PE ratio, which is a 5% earnings yield. Company Y has a net income of 240, 100 shares, the stock price is also 60, EPS is 2.4, corresponding to a 25 times PE ratio, and the earnings yield is only 4%. Question 1. For a 100% stock acquisition, without considering synergy, is the EPS dilutive or accretive? Company Y's market cap is 100 times 60, which equals 6,000. If Company X pays all in stock, it must issue 6,000 divided by 60, or 100 shares. After the acquisition, total shares are 200 plus 100, or 300. Combined net income is 600 plus 240, or 840. Combined EPS is 840 divided by 300, or 2.8. EPS drops from 3.0 to 2.8, a dilution of 6.67%. Why? Because you're using stock with a 5% earnings yield to buy profits with a 4% earnings yield. The economic logic already dictates that this is a dilutive transaction. Question 2. With 30% stock and 70% debt, if the dilution effect is the same, what is the debt interest? The deal is the same. We're only adjusting the financing structure. Stock is 1,800, debt is 4,200. Newly issued shares are 1,800 divided by 60, which equals 30 shares. The combined total shares are 200 plus 30, which equals 230. To maintain the same EPS of 2.8 as in question 1, the required combined net income is 2.8 times 230, which equals 644. The pre-acquisition combined net income was 600 plus 240, which equals 840. Therefore, the after-tax interest cost must be 840 minus 644, which equals 196. Now, to backsolve for the interest rate, 4,200 times R times 1 minus 20% equals 196. Solving for R gives us 5.83%. This 5.83% is a clear boundary. Below it, leverage can buffer the dilution. Above it, leverage will only amplify the dilutive effect. When you can quickly and clearly calculate accretion and dilution, you don't just understand the deal, you see through the deal. After all, the market only rewards those who can do the math.